Hello, in this lecture we're going to work some smaller test type problems that could be small enough to fit in a multiple choice type format. So here we have a company had fixed interest expense of $8,400. Its income before interest expense and income taxes is $19,600 and its net income is $10,000. The company's times interest ratio equals what? The company's times interest ratio. So we of course need to know what that times interest ratio means. And basically what we're trying to do is see how many times over the interest can be paid. And in order to do that, what we don't want to do is basically have the, so basically we want to take the net income divided by the interest for the year and see how many times over it could be paid. But many times we want to take out the taxes on it because taxes distort things. And we also want to take out the interest expense on it because we are trying to figure out how many times we could pay the interest expense, so we don't want to deduct the interest expense. So what we would have to do normally is take the net income, or the income before taxes. If we took the net income, we'd have to take out the taxes, and then we would have to take out the interest expense. And then we would have the net income before taxes and interest expense, and we could divide it by this interest expense, $8,400, and see how many times over we could pay that interest expense, being kind of like a security measure for a loan. In this case, they did it kind of tricky here. They just gave us the 19.6, which is its income before interest expense. So instead of having to back into that number, kind of like we would have to in real life, they just kind of gave it to us. And then they gave us this other information, which we don't really need, which is the kind of the tricky things that happen in smaller type problems. So all we need to do is say they already gave us that number, and then we got 8400. So we're going to take this equals the 19.6, so that's the net income basically before taxes and before the interest expense, and then divide by the interest expense, 84, we get 2. If we add decimals, we're going to go to the home tab, numbers, add some decimals, and it's repeating, so if we go 2 places out, it's 2.33, so we can pay over the interest 2.33 times with the net income before taxes. Next one says that L is an employee who is paid monthly. For the month of January of the current year, she earned a total of $8,638. The FICA tax for Social Security is 6.2%, and the FICA tax for Medicare is 1.45%. The FUTA tax is 0.8%, and the SUTA tax rate is 5.4%, are applied to the first $7,000 of the employee's pay. The amount of federal tax withheld from her earnings was $1,433.27. What is the total of taxes withheld from L's earnings? So I would usually calculate this in this way. We're talking about the wages for an employee. So we're going to start off with wages. Even though we're calculating the taxes, we're going to calculate the taxes based on the wages, of course. They say that the wages for this time period are 8,638. And then we'll calculate withholdings, or taxes, payroll taxes, let's say. And that is going to include, FICA is going to include 2 pieces to it. Social Security and Medicare both fall under FICA. So we're going to say Social Security, I'm just going to say Social Security here. And Social Security is going to be equal to this 8,638, the amount of wages, times 6.2%. So if we multiply that out, I mean, if I move the decimal over 2 places, it's 0.062. 6.2%, move the decimal 2 places over 0.062. That means we're going to pay $536. That's what we're taking from the employee. We will have to put in that amount too as the employer, but that's not what's going to be withheld from the employee. I'm going to go ahead and indent this, and then we're going to have Medicare. All right, and I'm going to indent that, and that's going to be 1.45 of wages. So I'm going to do the same thing. I'm going to take the wages 8,638 times, and if I move the decimal places 2 places over, times 0.01145, and we get 125. And then it goes into FUTA, which is a 0.8. Now note that FUTA is an employer tax, not an employee tax. We don't take that out of the wages of the employee, so it's kind of like they threw a curve in there. That's a trick question because they're not asking for what we paid as the employer, which includes FUTA. Same with SUTA generally. States could differ, but almost every state will have a SUTA of an employer side because of some laws that the Fed kind of put in to make them do that. But in any case, that's not an employee thing. So we're going to have the amount of federal, then we have federal income tax, the FIT, Now, this is the federal income tax, of course, that the employees pay, not the federal income tax that we pay on our wages as a corporation. And they're just going to give us that 1433.27. And it looks like we want to see some decimals here. So I'm going to highlight this whole thing, and I'm going to go to the Home tab and add decimals. So there we have that. And so then we're going to have this total withheld, which would be the sum of this plus this plus this. Social Security, Medicare, FIT. Those are going to be the employee withholding half of or part of the taxes. And then the net income would be the wages minus the withholdings. That's what we would then pay to the in net income. So note, this is what they're asking for in this problem. They could ask for this if they wanted to, and they could ask for the employer half. If they asked for the employer half, then that would include another 6.2 of the Social Security, another 1.45 that the employer, I assume that we are the employer whenever I think about these problems, we would have to pay another 1.45 as the employer. Then we would have to pay another FUTA 0.08, and we would have to pay SUTA of the 5.4%. That would be a separate calculation that we would have to be paying, not coming out of the employee wages. Next one says that the current FUTA tax rate is 0.8% and the SUTA tax rate is 5.4%. Both taxes are applied to the first $6,700 of an employee's pay. Assume that an employee earned a total of $12,500. What is the amount of total unemployment taxes that the employer must pay on the employee's wages? So in this case, we're not talking about what we're going to take from the employee out of their wages in order to pay their tax, their Medicare, Social Security, and federal income tax. We are talking about our payroll taxes, meaning the taxes that we as an employer must pay based on the wages earned by our employees. So that includes FUTA and SUTA. These are things that do not come out of the employee's pay. These are really kind of weird ones. It took me a while to really kind of grasp this, but for some reason there's a cap, and so there's going to be a cap. It's usually around 7,000. Whatever it is, you know, as long as you know how to calculate it, you can look up what the cap will be. And so in this case, we're going to say that there's a cap of 6,700. So we have to pay until the employee hits that cap. We have to pay 0.8% for FUTA and 5.4% for SUTA. And also, the reason we have to calculate SUTA on these problems, even though we usually only deal with federal stuff, is because there's kind of a federal law that forced basically all the states to have a conformed code in some way in terms of the SUTA, state unemployment tax. So that's why it can kind of be standardized in this way, that we can put it in these kind of standard problems. So in any case, even though they made $12,800, we have to calculate not their total wages, but their FUTA and SUTA wages. And FUTA and SUTA wages are going to be the lesser of their total wages, or the cap. And the cap is very low. It's 6,700. So they're almost all employers are going to hit that in the first or second quarter, which means we don't pay FUTA or SUTA usually in the third and fourth quarter for many employees if they've been there for the year. So we're going to say the cap is way low, 6,700 on that. And then if we calculate both of them, I'm going to say 6,700, and let's say this is FUTA. Let's say this is FUTA column and SUTA column. And then we're going to have the rates. And the rates can be confusing too because it's 0.08. So if I move the decimal 2 places over, it's 0.008, which is a very small number. If I go to the Home tab, Numbers, and I go to the percent, and then I still have to add a decimal, it's 0.8. So if I go to here, on the SUTA, it's 5.4. And if I go to the Home tab, Numbers, and make that percent, it's going to be, now I can retype it, 5.4. And then we're going to add a decimal. So there, sorry about that, 5.4. And then I'm going to underline this. Going to go to the Home tab, Font, Underline. Then we can calculate our tax payments, which will be the FUTA wages times the 0.8%, gives us 54. And then we're going to take the SUTA wages at the cap times the SUTA rate, and that gives us the 362. And if I add decimals to these, obviously if I go to the Home tab, Numbers, and we add the pennies, there we have the pennies. And then if we sum these up or add them up, the FUTA tax plus the SUTA tax would give us the $415.40 that the employer would have to pay for these employer taxes on the employee wages. Next one says that on November 1st, companies signed a $120 11% note payable with a face value of $14,400. What is the maturity value of the note on March 1st? So we took out the note in this case, and when it becomes due, we're going to have to pay back the principal of $14,400 plus the interest over that time period, which is 120 days at 11%. Remember, the 11% is a yearly rate, even though we only borrowed for 120 days. So let's take a look at that. We're going to say the note had an amount of 14400. We're going to have to include on that the rent on the note that we're going to have to pay for borrowing the money. So that is the rate at the rate of 11%, 0.11. I'm going to go here and say home tab numbers, and again it's 0.11, or go into the percent, 11%. I'm going to go home tab font, underline that, and then if we multiply that out, we're going to say the 14,400 times the 11% gives us the interest for a year. So remember that convention. Anytime we say interest, if I say 11%, I mean a year. I'm not going to say it's 11% interest a year for an 120-day note. It's a 120-day note, even though we're quoting a yearly rate. That's just the custom that we have. So if we want to break that down then into 120 days, then I'm going to take that interest, I'm going to divide it by the number of days in a year. So number days in year. You're going to say, well, it's 365. Well, we're going to round it like they told us to do here, which what they're doing is 12 times 30, average of 30 days in a year. That's where they're coming up with this 360. So then if we multiply that out, or divide that out, we're going to take the 1584 interest for a year divided by the 360 days within a year, and we get the interest per day. Again, if I go to the home tab, numbers, and add decimals, it might not be even, so that's okay. And then we just need to multiply that times the number of days in the note period, which is 120. We borrowed it for 120 days. If we go ahead and underline that, home tab, font, underline, and we multiply that out, then we're going to take the 4.4 times the 120 days. That means that we will have the 528 that we will then have to pay on interest. So that means that the total amount that we're going to pay is going to equal the original note amount plus the 528. Okay, so if we were to look at that in terms of a journal, that's what they're asking for here. But if they could ask for the entire journal entry, if they were looking for the entire journal entry, then we would have to pay cash. So cash would go down at the end of the note, and the cash would go down for the principal plus the interest. That's that 14 here. So we're going to say I'm going to say it's a negative or a credit of the 14,928. And then we have to take the liability, note payable, off the books. So the note payable is on the books, not at this amount. It's on the books at this amount, the amount we actually borrowed. So we got to take that off. Liabilities have a credit. We're going to take it off by doing the opposite, which is a debit, 14400. And then of course we have the difference here, the difference being the 528 that we need to debit in order to be in balance. I'm going to do that with our negative sum function. Negative sum of these. Take those two numbers, flip the sign. That's our plug, so that our debits minus our credits equals 0. And that plug will go to interest expense. So that's going to be the interest expense. Also want to note the alternative type of calculation you could have over here rather than by days. Remember, we had the interest 1584 for the interest for a year here, and then we divided it by 360 days. Well, what if we divided it by 12 months and we had it into a monthly total? Then we can say, okay, it's the 1584 divided by the 12 months, and then we're going to multiply it times how many months? Well, there's 120 days, and if we say, okay, 120 days divided by about 30 days in a month, it's the same estimate they're making with the 360, and that's how we get up. We can say, okay, let's say it's about 4 months. About 4 months, if we assume months to be even, which they're not, which is very frustrating, but we're going to even them out for our calculation here. Then we got the 132 times 4, and there's that. So some people like to think in terms of months, some people like to think in terms of days. Also note that when you see this written out in a text problem, they will take the 1584 and probably just multiply it times the ratio, which would be in this case the 120 over, alt enter, the 360. and you're going to see this ratio, which is actually more exact many times. That's why they do this, because remember we had this rounding issue sometimes over here. So if you see a ratio, it's like that. I like to write it out this way and to calculate the interest. I think that registers more clearly to most people.